Hey everybody, Tim here, Saturday, June 11, and I'm going to do a quick run through you on the SPX spreads that we've been focused on for the last couple of weeks because we now have SPX every single day. And there's a few people that really don't understand the mechanics of it all, and I want to run through the one that I was highlighting on Friday to give you a kind of walk through an example about how you're essentially making the best investment that you can make for a return of around 85% on the upside. So, anyway, really quick spreadsheet here, looking through all the details of what we've got going on. Friday, another shitty Friday, 117 points down from the prior day with a 43-point gap down, leaving that gap up there at 4017.82, which we do have a few going all the way back to January that are all unfilled to the upside. We have no gaps to the downside, but I'll cover that in the video later on that'll go out tomorrow. This is on the spreads. So on Friday, I was telling everybody prior to the open, anyone that is bagged on their June 10th SPX put spreads, you want to open up and you want to roll them over to June 17th, next week, Friday, to the 4,039.90 spread. They're collecting around $6 at the moment prior to the open. You've got your gap fill there at 4017.82. You don't want the AM ones because those are for OPEX, so those are going to expire prior to the open on Friday. But anyway, I was standing there, go for the puts. I like the Tesla 680 puts. You got a $2 credit on them, blah, blah, blah. They paid completely full credit as you got Tesla closing at 696.69. Great number. In any case, free money going around. And then I posted out here at 10:44 in the morning on that June 17th spread that it's collecting around $650 on $1,000 spread. It leaves you at risk of around $350 in total. That's an $85 profit, collecting at full premium, which is a close above 4,000 on June 17th, Friday, 4 p.m. At 11:37, I posted out there that you got a $7 credit if you can grab it. And I'll show you what we're talking about here. Is right here at 11:39, you had a trade go through on the 39.90s at 119.60. And at the same time, you had a trade go through just a minute prior at 126.80. You do the math there, 126.80 minus 119.60, $7 credit if you could get that great, fantastic fill on that. And here again is the chart, which again, I'll go over this in the video when we get into tomorrow for the week prep going into OPEX, going into the FOMC. But yeah, your Fibonacci extension, boom, boom, AB, right through the 250 extension there, right at 39.1875. We now have three closes right there between 3900 and 3901. Three closes at 3900, 3901. This big red is because we've got two red weekly candles. Again, I'll go over that when we come. What I'm looking at here is the spreads. So here you got 119.60, 126.80. That was a $7 width. If you could grab it, had you at around $300 risk. When you have here aftermarket, the open, close, the bid, and the ask, they're 100% not accurate. I mean, here you're looking at 117 on the ask, 104 on the bid. They're completely out of whack when you come here aftermarket. So this example isn't, ironclad, but you'll still get the idea of what we're talking about here. Optionprofitcalculator.com. I like using it after market hours to go out and run some ideas around to see what's trading, even though I've been doing this long enough that all I need to do is go and look at an option chain and I can already determine whether or not a spread is worth taking. I was looking at Goldman Sachs, I was looking at JP Morgan. Neither of them were worth anything. I was looking at booking.com earlier in the week. Horrible spreads, not worth taking. So anyway, I want to run you through this right here. Option profit calculator, you can look at all different kinds of spreads. You can look at all different kinds of customized legs and everything. And anyway, type in the symbol SPX, you get the price, 3,986. That's your closing price. Now, what I'm going to do here is we're going to buy the June 17th. We're going to scroll down and we're looking to buy the 39.90 puts. And they've got them quoted here at 107.40 because that was the close on the ask. We're looking to write, in other words, we're looking to sell the June 17th 4,000 puts, which again, because we've got the closing price, the bid and the ask are not accurate. They widen them out, and in any case, you've got here. But what you come here with is you got a $450 credit. So what that means in total is you are collecting $450 to enter into this trade. And your risk is $550. That's the difference between $4,000, $39.90. That's 10. So it's $1,000. Because you're getting $450, you have $550 that you don't know about. That's your risk. That's why when I was saying at 11:30 in the morning yesterday, you've got about a $7 width here that you can grab. And the example that I showed prior to that was around a 6.5. And that was because you had the VIX spiked up and elevated up into that 29 area. And that is exactly why you have that big wide width on your spread as far as how much you can make. And again, because these are in the money. The maximum return that you can get on this calculation that they have, which is a $4.50 credit, is 81.8% if you are able to close this trade above 4,000 on Friday, June 17th for full credit. 81%. Now, if anybody came to you and said, if you invest in this stock and you hold it for a week and you can make 80%, you would rip your clothes off and run naked through the fucking church screaming, Jesus is the devil. You would do everything that is against all means to get into that trade if you knew that you could make 81% by the end of next week. That was why I was pushing it, because here's the downside, okay? We don't close above 4,000 next week. We don't. Friday comes, we're trading at 38.80, 39.40, 39.70, whatever it is. We're below 4,000. So what do? You roll the trade to the next week. You roll the trade to the next Monday. You roll the trade to the next Wednesday. You roll the trade to any day you want because we have SPX trading every single day. The only difference, in my opinion, you're not going to get much better than a $700 credit with a $300 risk. So, meaning to say, if the risk starts to deteriorate and the credit starts to deteriorate, in other words, you've got less to risk because it's very probable that we're going to start breaking up above 4,000. You may roll this trade, and instead of having the $600, $700 credit that you had, you might only get a $300 credit. So, in other words, the $700 that you already got, you're going to have to give back 400 of that. So you're only going to get 30. You're only going to get 30% or yeah, $700 risk, $300 profit. You're getting around 50% on that. You're only getting $300 on the trade rather than getting $700 on the trade. As long as you're getting above zero, you're making money on the trade. And because it's only a 10-point spread, you're not widening it. You're not being greedy, and you're not causing yourself any harm. You're not causing yourself any major problems. You know exactly what your maximum risk is if you wanted to not roll the trade, just close it. Whereas you know that as long as you stay within the boundaries of that, even if you have to roll it another day, if you have to roll it another week, an 80% profit on that trade, come on. I'll talk to you a lot more about these spreads when you're ready to, but again, this is gravy money, and all that you need to do is expose yourself correctly. Talk to you guys soon.